And change, I mean, if there's one constant, right, it's going to be change. We all have to be continually changing, especially now because, you know, any type of education or understanding of the world we had that's 15 years old is like outdated, you know, so we have to all be constantly, you know, reinventing ourselves. They say now on average that everybody has 9 careers during their lifetime, so it's all about, you know, transformation and you know, changing. And let's start with just a little bit about what you might know about. So, like you've said, this is accounting, but this is sort of a specific part of accounting, right? We have 4 sessions so that we can't, you know, really get deep dive into all of accounting, nor do we really need to, you know. And what I've been a public company chief financial officer, you know, doing all the reporting and signing off on the 10Ks and 10Qs for about 15 years. I did that, and so I know about accounting and sort of what strategically what it's used for and all. And then I've been teaching for about 10 years in a whole bunch of different universities and all. And what I've realized that the way they always teach accounting is starting with sort of the minutia, right? You know, debits and credits and chart of accounts and general ledgers and all this kind of, you know, talk. And it's really difficult. I found it took me a long time after taking accounting to understand how all that stuff fit into some sort of big picture. You know, the whole idea about seeing a forest through the trees, right? You get all these details, and a lot of times when I've taught it too, I'll start out with just the broad strokes. And I'll say, okay, you know, what's on this, what's on, and people panic, and they, you know, it's like deer in the headlights. You know, even people have taken 3-4 accounting courses, know this stuff, they just don't feel confident in their understanding of accounting. So what I did was try to flip it on its head and say, okay, what is the big picture of accounting? What's the context? And then as you start to learn all the details, you can just fit those in, and you can feel confident that you know what it is. And I also, it's not an unusual, you know accounting. You know accounting. You may not know that you know accounting, but you do, because it's how we run our lives. Our lives are like a business, and we do accounting. So that's the other thing. I'll put it into contexts that hopefully you'll relate to, because you've been doing it all along, and you'll be surprised that, oh my gosh, I've been actually doing lots of accounting. And then as you start to learn the more details, you'll understand that they're in the service of this larger picture. And the larger picture is financial statements. And that's what we're going to talk about here, is financial statements. And so you can think of financial statements as what accounting produces. That's what accounting does. Accounting is, the end product of accounting is creating financial statements. So as you know that, then all the work that you do in accounting, it's like, oh, okay, I'm doing that to create financial statements. So that leads us to the question, what the heck are financial statements? Anybody have a kind of a clue what it might be, what they are?
Oh, well, you got a cash flow statement, you have your balance sheet, income statement, owner's equity.
That's it. That's it. Very, very good. There's 3 financial statements, right? There's 3 financial statements. There's the income statement, the balance sheet, and the kind of tricky one is the cash flow statement. But we're going to go through these in a way that you'll understand what the heck they're doing, how they're doing it. And all 3 of these are interconnected, and the numbers flow through them. And so that's what we're going to, that's the way we're going to, approach this, is we're going to talk about these 3 guys and how they're interconnected and how they flow. And that's what we're going to do over the next 4 sessions. So, I used to start with the balance sheet a lot, but I think I've changed. I'm going to start with the income statement, because that is the most intuitive financial statement and the one that we really know. So When we think about an income statement, there's three main parts to an income statement. And it's just like what we do every month, right? There's the money we get in, right? And in accounting, whatever we call it, revenue, sales, whatever. But you could think of it as your pay from your, from your work or whatever. That's a lot of times referred to as the top line, right? And then there's expenses, right? And expenses are everything that we pay. And then what's left over is called net income most of the time. So the relationship between these two things, right, is what? It's we subtract expenses from revenue, and that's what gives us net income. Same thing, and so you can think of your operation, right, as you get your paycheck, and then you go and you pay your mortgage or your rent, your car payment, you get food, you get clothes, all those kind of things, and hopefully at the end of the month, there's something left over, or at least you're at zero, and then some months maybe you run a little negative, so you have to put it on your credit card or something, and that would be in a business would be like the line of credit, or same kind of thing. But you don't want to do that too much, if at all. You don't really want to do that at all, right? So what we really want to do is have, our revenues, our expenses, and then the net income is also called profit, right? Sometimes we call it profit. And there's a lot of these terms that have synonyms, right? And so sometimes you hear somebody say net income or they say profit, and you think, oh, there must be two different things, and they're really not. It's the same thing, right? And there's one other word that's used a lot for earnings. Anybody pay attention to the stock market or any companies like that, and hear about those kind of things? Well, this time of year, for most companies, what they do, companies do is they report, public companies, right, traded on the stock market, report every quarter what these kind of numbers, right? So every quarter, there's this big kind of season, and at the end of the year, basically, most companies, that's their fiscal year, so that's their whole year. And so in January, all the companies report to their shareholders on a big conference call and stuff, how much money they made, their top line, how much their earnings were. And then all of the analysts for all the Wall Street banks and stuff have made guesses what they think those numbers are going to be. And then if the company actually comes in higher than their guesses, then the stock does good. If they come in lower, then they get punished, and stock goes down in price. So the last few weeks this is like earnings, what they call earnings season. Like in every company is getting on the webinar, and usually they have the CEO comes on at first, like Jeff Bezos or something, and say, hey, we're doing great, and then they turn it over to the CFO, the numbers person, and they sort of run through all the numbers and stuff like that. So it's really interesting if you invest in any of the Apple or Tesla or any of these companies, IBM, just any of them, you can sit in on those calls and listen to these guys sort of squirm and have to report, that they performed well or not. And it's very interesting to listen to those conversations and then see what happens afterwards. So a lot of times for those companies too, the way that they report that is they do earnings per share. You might hear that, right? And EPS, earnings per share, is just basically taking the earnings number and dividing it by how many shares of stock is outstanding, right? And a share of stock is just a piece of the pie. You have an ownership pie, right? And it's divided into lots of slices. And big company, you might have a company where you have just one owner, owns 100% of it, like the woman who owns Spanx. She owns the whole thing, Or it might be a company where someone owns, 20% of it, and they've sold off a bunch of it to shareholders and things like that. And they might have 1 million or 500 million shares outstanding. So if it was 1 million, you'd divide the earnings number by 1 million shares to get, the earnings per share. that idea of just doing those kind of things, making divisions and stuff like that, or seeing what the what happened the year before, right? So you might have, this might be, 2018 numbers, and then in 2017, the revenues and expenses and the net income were something else, right? And then you'd look and see, did it increase or did it decrease? Is the company growing? Maybe their revenues stayed kind of flat or even went down, but their net income went up because they reduced expenses. There's two ways. What you're trying to do is make this number go up, right? And there's two ways to do that. You can either increase this top line, make more sales, right? Or you can reduce, your expenses. And you hear about that all the time with companies. Like Tesla just announced they're laying off, 2,000 people at their manufacturing plant because they have to make more net income and they have to make the cars cheaper so that they can get down to that. They promised they were going to have that M3, the Model 3, cost $35,000 and it's still at like $43,000. They haven't been able to figure that out. So if we cut some people out, maybe we can drop this and then we can still, with a smaller revenue, because each sale will be less, right? We'll still make money. So that's how these kind of numbers interact. And in that case too, your revenues, there's a couple of ways to increase revenues, right? One is to just sell more at the same price, and the other is to increase the price a little bit, right? So you think about Amazon Prime. Amazon Prime just announced they have 100 million subscribers. That's just unbelievable. That's like a third of the country has Amazon Prime. And anybody here have it? Well, that's like about 100% of here. I have it too, yeah. Anybody not have it? No, see, isn't that amazing? That's pretty remarkable. So that's 100% of, just think about,
so handy.
The what?
It's so handy.
It's incredibly handy. Yeah, after a while, it's like, how can I not? Yeah, free shipping, and you get to watch all the movies and stuff. Is like just having a free Netflix, It's and you can borrow books from their library, the e-books and stuff like that. So you can just look at those for free on your Kindle app, which is free to download on your phone. There's just so many ways that it's, and now if you shop at Whole Foods, you get discounts and all kinds of stuff, right? It's really remarkable that they've made it an incredible value. But last year, I think they increased the price from 100 to 120 or something like that. Now think about that, though, when you have 100 million subscribers. That's subscription revenue, right? When you think of Amazon as a pure play e-commerce thing, which it's not, but that would just be every time they sold something, they'd make a little retail margin on it, right? They'd sell it and they'd make some money. But in this case, they have one of their revenue lines, and that's one of the things you want to have with a strong company is you want to have multiple revenue streams, right? So you have this robust, sort of, if one goes down, the other one comes up. You don't want to be a company where, like remember the Godfather movie, and Robert Duvall said, "I have one client." You don't want to have one client, right? Because if the client goes away, then you have no company. So you want to have multiple clients or something. So they have one of their lines is, just think about that. 100 million people times $120. I don't know, I can't do the math in my head, but it's a lot of zeros, right? A lot of zeros. What is it? Let's see if we, well, 1,000 million is a billion. So that would make it a billion. So it's 12 billion in recurring revenues every year just to subscribe for that stuff. Now, it costs them a lot to make that, right? Because we're getting free shipping. And what they call their fulfillment costs, right? The expense in here that's related to that is pretty big, right? Because they have to pay FedEx or if they pay UPS or whatever. And so of this 12 billion, heck, maybe they're making some money, maybe they're not. Maybe it costs them 13 billion to, fulfill all those orders and stuff. Or maybe it costs them 10 billion and they make 2 billion. I'm not really sure, but you can see that it's not just free money, right?
Definitely put it into the cost of the good. So, like, for example, I bought French vanilla syrup the other day, and at World Market it was $8, but on Amazon, because that's the first place I went was to Amazon, it was $13. So
it was cheaper at the other place. Wow.
It was cheaper because
Because they have to.
They have put the price of shipping into the price of the good.
Well, and that's another thing, to think about is exactly price and what is embedded in the price. A lot of times with Amazon products, they're less expensive. They have an app where you can go into, it used to be, you could go into Walmart, I guess anywhere, and you put the barcode on the thing for the, at the Walmart, and it would give you the comparison price. And it would always consistently show, I mean, obviously they wouldn't do it otherwise, that Tide was, $3.20 at Walmart and $2.90 on Amazon. I'd be, oh my goodness, I'm gonna get it. But you're right. That's probably a way that they do that is to price it in, and they probably price it into goods. These people are very sophisticated. Walmart, all these big retailers are very sophisticated about making determinations about what products we know about and we know the price of, and what products we don't know about, and so that they can manipulate us in those products and price it higher. And maybe some vanilla syrup. And vanilla is another thing, though, that's been going up in price like crazy, because if you get vanilla extract or something, Madagascar used to make most of the vanilla, and maybe 10 years ago the crop went away, and so it's a supply and demand thing, right? You go in the store now, you buy vanilla extract even in Sprouts or something, and a little bottle like this is $10. Even at Costco, they have one that's about this size. It's $35. It's really gotten super expensive, and maybe over time somebody will start, growing vanilla beans in New Mexico or something and try to compete and probably bring down the price. But so that's another. Price is something that is a function of revenue, and then pricing in things that might be expenses to subsidize them is another way to cover those kind of costs. They're wrestling with all those kind of issues, but still, that's a big number, $12 billion in recurring, just recurring revenue, because unless some unforeseen thing happens, we're probably all going to be Prime members for the foreseeable future, right? Next 10 years, 5 years, who knows? But gosh, it's incredibly convenient, and you can get everything. And so this is the math of an income statement, right? It's very, very simple in this, where you're just subtracting one from the other. And so this is called the top line. Guess what they call this? The bottom line. And that's a phrase you hear a lot, right? When people are saying, what is the net of all these different opinions or whatever, the bottom line is this, and so that's where that phrase comes from, really, is the bottom line of an income statement. And this is basically the profit. This is how much a company makes. Make sense? And you know it from it's intuitive, right? You know it from your life, right? If your outflow is more than your income, then your upkeep is your downfall. And the same thing here. So we could do these type of. I want to introduce the concept of ratios, right, and ratio analysis, because when we do financial statement analysis, it's all ratio analysis, and that's where we're doing performance, right? And what is a ratio? Basically, a ratio is just, one number over another, like dividing, right? That's what a ratio is. So earnings per share, it's a basic statistics. Like you see performance things in sports, right? How many times did somebody strike out per at bats or whatever, those kind of things. Same thing with companies, right? So there's basically two ways to do them. One is vertically, where we're in just 1 year and looking at earnings per share, or we could do what's our profit margin, right? And we could say, well, if we put net income divided by revenue, this number is going to be less than 0, right? Less than 1, right? This is a big number, and this is a littler number, right? So say it's 10%, right? That would mean that if this was $100 and this was $10, that would look like that, right? It would be 10%. if this was $20 and this is $100, it'd be 20%. So, you can start to analyze performance of your company and say, well, how is that? And then you can benchmark that to maybe other ones in the, in your industry or something. So are we performing better or worse than our competitors, right? Many times you can't find your competitors because they don't share their, financial statements. The only companies that share their financial statements, and they have to. I'm sorry?
Oh, nothing.
No, what are you going to say?
I just said publicly traded companies.
Exactly. No, please, don't. Let's make this more of a conversation. Yeah, I like it when you guys ask questions or complain about Amazon or something. They always say, I don't want it to be like, the sage on the stage, where I just blah, blah, blah. I want it to be more of a, so ask questions too, anything that comes up, anything you're thinking about.
It would be interesting to see, because there's a few places in town that are similar to our business, what their profit margins look like.
Right.
Compared to ours, but of course, we can't go.
You can't do it, or else you could go and work for them for 2 months as a spy, and then come back and give her all the information.
Sean would lose his mind. Yeah, there's no way.
The
espionage.
But like you said, public companies, and that's one of the, there's the pros and cons of going public, and everybody thinks that that's the holy grail is to have an initial public offering, right, an IPO, and then you get all this money, but then running the company that way, suddenly all this disclosure, before you could be private, you could be like the president and say, I'm not going to tell you what my incomes, my tax returns are, but they're really huge, or whatever that you want to do, Once this happens, you have to say exactly what you have to show, and it has to be audited by a third-party accounting firm that says, yes, they followed all the rules and these are the numbers. And so then all of your competitors can see exactly how much you made and what you're doing and what your profit margins are and what your cost of goods sold is before you get into, and how much you're paying for all these different expenses and all that kind of stuff. So it's a competitive advantage not to disclose those things, and it's a competitive hindrance once you do. But a lot of times what you can do is look at companies that might be in a similar business that are public, and then maybe use those to benchmark what you're doing. That's the closest you can get a lot of times. So that's competitive analysis or performance analysis, and you can even just say, we want our profit margin to be, and even if it is 10%, well, maybe we can make it 12% next year or whatever, those kind of, even where you are, you can see if you can increase your performance or know what your performance is at least, even if you can't benchmark it accurately. The other way is horizontally, right? So that's like vertical analysis. You're just in 1 year, stacking one number on top of the other. Horizontal is how have we performed year to year, right? And that's where you see a lot of these, the typical graphs, right? Where, we're growing like crazy, right? That kind of stuff. And you want to put some kind of number to that and say we grew by, revenues grew by, 32% last year, and net income grew by 47%, or whatever it is, or 14%. You can start to make those kind of analyses, and then you can see performance-wise how you're doing over time. The income statement actually is the statement that is over time, right? So the income statement would be for some sort of time period, depending on how much you like to look at those kind of things. You might look at it weekly or monthly or quarterly. Like all the public companies put out a quarterly statement, right? Once a year, they have to have an audited annual that's for 12 months, and that's called a 10K. And then each quarter, the other 3 quarters, right, they put out a 10Q, which is a little bit lighter kind of reporting, but says this is what we did in the last quarter, right? So every 3 months, they put out that. And so that's for, that time period from, say, January through March maybe, might be a reporting period, and then, April, through June. And you'd have these 4 reporting periods, right, that break down into 3-month intervals. So you're looking at your numbers from that time to there and how much you made and spent during that time.
So those 10Ks and 10Qs are only for publicly traded companies?
Yeah, the 10Ks and 10Qs are jargon that's used by the Securities and Exchange Commission, the SEC. And the Securities and Exchange Commission is the government entity that oversees publicly traded companies. So if you want to be on the stock exchange and have that liquidity, basically, where somebody can invest in you and then they can go and sell the shares tomorrow and get their money back if they don't like it or whatever, that's a very nice thing to have, and it gives you good pricing. It's basically an auction, right? You know, somebody has shares of IBM and they say, I'll sell them for $100, and somebody says, well, I'll buy shares for $90, and you know, maybe they make a deal at $95, and that's struck. And that's how the stock market works. It's an auction that's going on continually. That spread between the bid and ask, think of it like eBay, right? You know, is much less because it's traded a lot than $10. It wouldn't be $100 and $90. It's probably like, you know, just pennies, you know, and that's why if you look at a stock price, right, even from one day, it's like, you know, you see this thing like this, because each one of these is a transaction that occurred at 11 o'clock and 11:03 and 12 o'clock and 1:42, and that determines the price of that stock at that time. So, and then it'll close at a number, and but that closing price just happens to be the kind of random last transaction that happened, you know. And if people are really liking the stock, then it starts to go up because people are bidding it up, right, that are buying it. And if people don't like it, there's more sellers, and so it's going down. And so that's how the stocks work. Now, these financial statements, the 10K and 10Q, it's really interesting. Back in the day, right, we had a stock market since they used to meet under a tree in Lower Manhattan back in the Revolutionary War, George Washington, these guys, you know. And little by little it got formalized. And by the turn of the century, after World War I, it was just bustling along, you know. And there were a lot of, you know, booms and bust kind of things in the 1800s with railroad stocks and all kinds of stuff. But then, you know, it was a real run up in what they called the Roaring '20s, right? It was like, oh, the stock market. But there was no reporting. It was just like, I got a tip from my, you know, shoe shine boy, and he said, you know, buy this stock, it's the best thing going, because he heard it when he was shining shoes. I mean, literally, it was these rumor mills, right? And people would buy stocks based on these rumors, and you know, stock manipulators got very good at manipulating that rumor mill, right? And so then in 1929, suddenly the stock market crashed, and everybody realized that a lot of it was just, you know, rumor, and there was nothing substantiating these companies that everybody thought was so great. They were just like speculating, right? Just speculation on a price. Just like they speculated on tulip bulbs back in Holland in the 1600s, and they drove up the price of tulip bulbs because they thought they were such exotic flowers to extravagant numbers, and then suddenly that whole market collapsed. And we have this history, commerce-wise, of just dumb markets where we, you know, make a big bubble, and then the bubble bursts, and we have this collapse. So when the stock market collapsed in 1929. Obviously, a lot of banks and people were holding these assets, and that's a part of a balance sheet. We'll talk about that next. But you know that suddenly were worthless, and so they all went bankrupt. They went out of business, and they still owed money to people, but they didn't have the assets to pay for it. You know, if you think about it, sort of like a house that suddenly goes down in value, and you're underwater. So all the banks folded. You know, they just folded, and we went from a stock market crash in 1929 into the Great Depression, where all the banks folded. There was no money around to lend to businesses, so businesses closed up. Everybody was out of work. There was like 30% unemployment, probably more in other sectors, and it was just a disaster, right? The country, it looked like capitalism had absolutely failed, and it was really a crisis time for democracy and capitalism, and a lot of people thought that it was a system that just couldn't make it because of those reasons, right? And so they started looking at other systems, socialism, communism. Russia started looking really great. They were exporting all this wheat and all these things, and people thought, my gosh, that central planning is really working, while they were starving their people to export the wheat and stuff so they'd look good. And socialism was on the rise. We had a thing, National Socialism, which in Germany was what the Nazi Party, that's what that stands for. So all of these other alternatives to free market capitalism and democracy and sort of free rule with a constitution all came into question. It was a real crisis time. And so who comes into power then is, do you know?
Isn't it FDR?
FDR, yeah, FDR. Franklin Delano Roosevelt comes in, and he starts to implement these policies to try to shore up the government on. Well, one of the things he does in 1934, 33 and 34, there's the Securities Exchange, acts that we are going to now demand that any company that's going to be traded on the stock exchange is going to have to report financial statements, an income statement, a balance sheet, and a cash flow statement. And those things are going to have to be audited by outside auditors to say that they're not cooking the books. It's actually done by GAAP, which is stands for the generally accepted accounting principles, right? That's a phrase that you'll hear a lot. That's how these things are done. GAAP in America, generally accepted accounting principles. And when an audited financial statement means that a prestigious accounting firm has reviewed the way that you do all your books and how you assemble and you keep good invoices and receipts and all that kind of stuff, and that your financial statements are legitimate. And so every company was going to be on the stock exchange had to do that. And so suddenly we had this transparency, right? We had this way of looking at this that we never had before. And people just like us now, right? And you're like, well, what the heck are financial statements, and how am I supposed to read these, and what am I supposed to do with them? It's like every company's given it to, but no one, few people do, but not too many people knew how to read them and all. And interestingly enough, when FDR, when they made the SEC, the Securities and Exchange Commission, got these rules through, they needed somebody to run it, right? And they wanted to have, like it takes a thief kind of thing. They wanted to have someone who was a very knowledgeable stock manipulator to run it, so that that person could say, here's all the tricks that were used. This is what we have to do to eliminate those tricks so we can have honest markets. Because really what it was all about is they had to bring back faith into the markets, that it wasn't rigged, that it wasn't fixed, that it wasn't all these fat cats on Wall Street whispering to each other and trading things, And so that's been the SEC's job ever since, is to retain investor confidence in the markets, that the markets aren't rigged, right? So who did he pick? He had to pick somebody who really knew how to manipulate the markets and was a trickster, knew how to do all that kind of stuff, and get that person to do their patriotic duty and now run this new, government organization to do that. So the guy that they got to do, the guy they picked was Joseph Kennedy. John Kennedy's, the President Kennedy's dad. He was a major, stock market player and Hollywood guy, all these kind of things. And so really interesting that he was the first commissioner of the SEC. And so we had these financial statements now, right? And so now what are we going to do with them? How are we going to use these things for investment and things like that? Well, there's a guy named Benjamin Graham, and he's a professor from Columbia University at that time. And he wrote a book called The Intelligent Investor, all about a new thing called value investing, where here's how you can take those financial statements and start doing this kind of ratio analysis and look at, are they growing? Are their expenses too high or too low, relative to their, to their revenues, all that kind of stuff. And then make decisions about whether or not you should invest in this company, not speculatively based on the rumors of, people that may have a vested interest in pumping that stock, but actually on your own, rational analysis of the financial statements. So that's where they really became super valuable, and where it really became a thing that everybody, that everybody does and reads and things. Same now, right? When you go to a bank, or if you want to get investors in your new company or something, or bank, you want to get a bank loan, or you want to get a line of credit to sort of smooth out the revenues and stuff, you have to show them, operating history and some financial statements, and most likely they're going to want to see them audited by an accounting firm, not that just, here's the output of our QuickBooks, take it, it's really good. They want to know that it's actually been looked at by someone else. And if you have investors, believe me, if I'm an investor in a company, I want to see that every quarter or something, how are you doing and who's looked at these books, and make sure that they're not, And we've had lots of instances lately where those rules have been bent, right? Anybody remember Enron or, WorldCom? There was all these big, there was changes to the rules in the early 2000s because companies like that were cheating on this kind of stuff, right? The Enron CFO had done all this manipulation of the books and tricked everybody. Everybody thought he was a genius and a wizard, and the company thought everybody thought they were doing great. All these poor thousands of people that worked for the company had all of their retirement, 401ks were in Enron stock, so when the company collapsed, they lost all of their retirement, even though they'd worked maybe 15, 20 years, really hard, and suddenly they had nothing, And that fellow went to jail, and they actually put the CEO in jail too, Jeffrey Skilling. And I've read a lot of books about that. He's the CEO. He should have known, I guess, and he's held responsible. But it's really tough when you have somebody who's the CFO and is manipulating the books, and you say, "Wow, you're a wonderkind. Everything's really great." It would be very easy to not catch that, and then you're responsible for it. And he went to jail. And the chairman of the board, the guy who built that company all the way up and stuff, during the trial, he had a heart attack and died. I mean, he just could not handle that his company, that he didn't know about it, and that his company was built on a house of cards that CFO had cooked. So there's lots of companies that do that, and even every day, on Wall Street, you always hear these kind of stories of companies that are, because there's this tension between, you want to have these numbers look good, so the stock price looks good, so you get your bonuses, and everybody, the company's going, and you keep your job if you're, a C-level person, and maybe what the actual performance is. So you start trying to figure out, well, maybe we can book sales really in advance. If somebody just gives me a handshake, okay, that's a sale, I'm going to book it, even though they may or may not buy it, and maybe 2 years down the road, all that kind of stuff. Or how can we figure out how to make our earnings, our expenses less, so that this number will look bigger. And there's lots of ways to manipulate those kind of things.
For smaller businesses, do you have to have a financial statement a year to show to the bank to get a loan, or would you have to So what you're saying is, a smaller business just starting out, you would have to show, besides the business plan, do you need
Yes.
If you have nothing to show, if you have no income, is what I'm saying, you're just starting out.
Then you're not going to. Then the bank's not the alternative for you. That's why when you're looking to raise money for a company, there's two ways to do it, right? There's stock and loans, right? Debt, right? Equity and debt. And to go and get a loan, you have to have some assets to loan against, and we'll talk about that on the balance sheet, which will be next, and then it'll make even more sense. But and you have to have a history. For a bank, they want to see a credit history. It says you've been in operation for 3 years and you've made X amount of money, and so this number here, whatever this number is, if we give you a loan, say if your net income, say if you want to get a loan and the cost of the loan is going to be $500 a month, right? And maybe you're borrowing $10,000 or something for 5 years, or whatever the math works out, right? And it's going to cost you $500. Well, what they look at is something called debt service coverage ratio, right? And they have these, junior folks, they're credit analysts, and all they do all day long is say, is this person a good bet? What a bank wants to know is, what's the risk of me not getting my money back? That is the credit risk. So any type of debt, if you're investing in bonds, or if you're a banker and you're investing in a company and setting up this obligation, your risk is that person going to be able to pay me back? And if they can't pay me back, what can I take from them and sell to pay me back, right? So that's like when you have a house, right? A house, you don't really own the house. The bank owns the house with the mortgage, right? And you're paying on it. But if you stop paying, what happens? The bank forecloses on you, and they take the house and they sell it to get back the money that they lent you. So a bank is not a place to go for money for a company just starting out, because you'd have to show, say if they said our debt coverage ratio is that you have to have 50% coverage, right? And they have their rules. So then you'd have to show that your net income has been $1,000 a month for the last, 3 years or whatever their term is going to be, because they want to predict that, okay, that's going forward, they're going to be able to pay me.
Can you use your personal assets to?
Well, you can do a personal guarantee. That's the kind of thing. You don't want to do that. You want to sort of lend on just the standalone of the company. But a lot of times that's what a bank will ask for too, is a personal guarantee. And so but that is dangerous, because then if the business fails, depending on what you guaranteed, they can garnish your wages, they can come and take your house or your car, or, all your kind of stuff. And what they're looking for is, and they want to have assets that are worth quite a bit more than they lent, because they're going to have to sell it at a fire sale, right? And say if it was a house, right? Say that you put $10,000 and then you guaranteed a house and it's worth $50,000. So okay, well, if we had to sell it really fast, we could probably sell it for $12,000 or something like that, and just make the money. And you'd be like, oh my God, that's my house. It's worth much more than that. You just have to wait 3 months for somebody to buy it. But nope, they want to sell it next week, boom, at auction, and just grab what they can. And so they're looking at some discounted amount on the assets. So banks can be pretty tough on a fledgling company. Now the other way, there's 2 other ways to do it, right? To finance a company. One is what they call bootstrapping, right? And that's the best way, where you keep all of the ownership, because the other way, the thing that when you do a bank loan, you're giving them a lien or some sort of priority on your assets, right? The stuff that you own. You say, I'm going to buy, with this $10,000, Mr. Banker, that you give me, I'm going to buy a truck and a machine, whatever. And they'll say, okay, then if you fail, we'll take the truck and the machine and do that, plus your house and your car and everything. But the other way that you can raise money is by selling a portion of the company, right? And that's where you get angel investors and venture capitalists and those kind of people that buy stock, and they'll buy a quarter of the company for $250,000 if you had $1 million valuation for the company or something, right? Then you have to figure out, how do you value the company and all. And they come in and they end up trying to take the company over anyway. So that's kind of dangerous too. The best way is to do what I was just saying, bootstrapping, right? And that just means that you use the money you make to plow back into growing the company more and more. And then you keep control. You don't have any bankers, to worry about. You don't have any, shareholders that are, calling you up every day and trying to why aren't you making me more money? The last thing you want to do really is have investors, because believe me, they turn into they want you to sweat blood to make them money. So, they gave you a little bit of money that, you're hiring yourself a boss. It doesn't make any sense at the end of the day. It's like, I went into business to be my own person, and now I got this banker and these 2 shareholders, whipping me every day to make more money for them. So the nice way to do it is to start out small with any kind of business. Start out small, test the waters, and little by little, build it up with just the money that you make. Instead of making it, the other thing is with making a business plan and then saying, here's my business plan and I'm going to go execute on this plan, unless that plan is predicated on lots and lots of talk to customers that have seen what you have and they're actually buying or whatever, so you have product market fit and you have a product that people really want to buy and they're going to open their checkbook and pay you. A business plan can just be a delusional, work out of your mind, right? You just said, okay, well, I'm going to have this many customers, and the next year I'm going to have this many customers, and then this is how much they're going to pay me. Wow, this looks really good, but it's just on paper. It's never been tested and really that's not a good way to do business. So you don't want to get into that kind of a situation. And that used to be, even 20 years ago, that's the way that businesses would start, and they'd raise a whole bunch of money, and then they'd go out and realize, and then they'd build something for a year, and then they'd go launch it and realize no one's interested. Oh my God, and then the company would fail. Or they'd have one little part of it that people really liked, but they had burnt all their money, so they couldn't go back to the drawing board and capitalize on it. So on the thing that people actually liked. So now the whole practice is more, you build what's called a minimal viable product, something that's just the feature set of just the things you want, that you think that people are going to like, and you go and present it to people and say, what do you think? And then as people say, yeah, I like that, or gee, oh, it does this too, and you thought they were going to like this, but they really like this part, and then you go back and you redo your thing to find out what people like, and then that's how you ultimately end up doing your business. And that, in your business, I'm sure there's been lots of things like that, right? Where you think this part of the business is going to be the real popular thing, and it turns out to be this part of the business. And so you have to be flexible in what you pick, and don't invest too much in one part so that it's hard to move, because you want to be nimble and be able to what they call pivot or iterate, do little by little, progressively make it better. And with a new business, that's the big decision is, when you think about entrepreneurs or entrepreneurship, it's all about perseverance, right? You got to just, no matter what anybody says, you keep doing it and you keep doing it and you plow through. Everybody said I was wrong and I proved them, wrong. I actually, it did it. Well, that could work, but a lot of times if you're banging your head against the wall, there's a reason, and so maybe you should change over to this a little bit. And so what they call persevere or pivot. Do you change what you're doing, or do you keep doing the thing because it's right? And that's really where it gets to be that's where the art is. That's where, entrepreneurs are forged in that, do you persevere or do you change what you're doing? And a lot of times it's hard for people to change because they have this idea about, it's their beautiful idea about what the business is going to be. And people like this part, and they're like, those stupid customers, they don't understand. I've got the greatest thing ever, instead of saying, wait a minute, the customer is the arbiter of all this. And so you have to really design your thing for what they want. So so banks, at the end of the day, yes, a bank will want to see financial statements. And those financial statements have to be for a certain amount of time, and they have to be audited. So you have to have a history before you can go to a bank and start working with a bank. So banks really don't play too much in startups. They're for companies that are continuing along and working. What did they do? They don't have a clock in here, huh? They took it out?
It's on my computer.
Oh. So these are all good questions. How about you? You're going to be doing budgets and all at the? Mm-hmm.
Yes. Well, pretty much I'm going to be working on creating the budget for the next fiscal year.
Mm-hmm. For the year. So let's talk about budgets because I'm going to erase this. Huh? This is getting a little bit crowded. Because budgets are based on income statements. So it's a good time to talk about them. Anything else? Any questions about any kind of stuff? No? So budgets are the same kind of thing, right? Revenues, expenses, and net income. So if and you might call them financial projections or budgets, right? And sometimes you hear them called pro formas if they're going out into in the future too. And pro formas are sort of a short term for financial projections into the future, right? And they call them pro formas. That's the Latin phrase for in the form of, and because it's in the form of an income statement, they call them pro formas. And so when you're starting a company, doing a business plan or something, you may have, say if this is year 1, you may have year 2, year 3, year 4, year 5, whatever, and you'll have some wild guesses about what these numbers are going to be, going out into the future, right? when you're doing a budget, what you're doing is basically you're doing this year's, just the first year's, right? And so a lot of times when you're creating a budget in an existing company, you have last year's and the year before and the year before or whatever, so you have some sort of an idea of where expenses are. By the way, what do you think is the biggest expense in a business?
Salary, rent.
Salary. Salary, in most cases, is 50% or more, like 70% of most businesses is the humans. And it's good to understand what are the big chunky ones, because then you don't have to, because a lot of times you'll see, 30 line items of expenses, but really only 2 or 3 are the big ones, and then the other ones might be, 2% of stuff, and then see the ones that impact everything that's why Tesla what would the first thing they do is cut employees, because that's a big chunk of the money going out the door, So when you're doing expenses, a budget, you're going to do the next year's projected income statement. And how do you do that? There's a couple of ways. A lot of times I'll say maybe if you're gonna have you want to create the budget, and then you want to have the board of directors or everybody to approve that budget, and then that budget is in stone for the next year, and you're going to operate off of that. So there's a couple of things there. One is that you're going to construct this budget, and so that happens in kind of 2 ways. One might be that you have the controller or the CFO, whoever is the top persons that are doing it. They might come up with a budget, and then you might have a call from all of the managers to make a budget for their department. And then you aggregate that up into something that looks like a budget too. And then maybe you sort of reconcile the two. You might have a budget from the CEO and stuff and say, I want to grow revenues by 20%, and we're going to cut expenses by 15%, go take care of it. And then you get everybody else's budget, and it doesn't really come out that way. They're like, where are we going to cut? We can't cut anymore. We've cut everybody. Everybody's working so hard. We can't get that many more sales. We just don't have the salespeople or whatever, and so everybody down here is whining because they're the ones that are going to have to implement these grand notions that come from the top, right? So you have this bottom-up approach and a top-down approach, and somehow you have to reconcile those. And so then you come up with some sort of budget that the management feels is good, right? And then in a corporation, the management actually answers to the board of directors, right? In a company that's a corporation, you have a board of directors, and they might be 3, 5, 7 people or whatever that don't really work for the company, right? But they oversee it all. And then you have the CEO, right, that runs it. And then you have the other C people, the CFO and a COO and a chief of information officer and a CTO, chief technology officer, all those C-level folks, right? And they're the ones that are actually then, managing everybody and the whole organization. So usually you have the CFO and the CEO on the board too, or they report to it, and they'll make a presentation to the board and say, here's our budget for next year. Da-da-da. The board might say, that's great, just do it. Or they might be activists and engaged and say, go back and sharpen your pencils. We really need to do this and that to get the performance where it needs to be or something. And then maybe a month later, or 2 days later, they'll come back and say, okay, here it is. Sooner or later, it gets approved, right? The budget gets approved. And once the budget is approved, then that is what we are operating on for the next year. And you'll have that budget in monthly usually, right? 12 months. And so every month what then happens is you have the budget, right? Numbers. And at the end of the month, you'll go and actually make an income statement and say, okay, here's the actuals for January. And you're going to compare that to the budget, right? And there's going to be some differences, right? You might have spent much more on something than you thought you were going to, and you might have made less sales or more sales than you thought. And then you do what's called a variance, right? A variance. And the variance is the difference between what the budget was and what the actuals were. And then everybody goes through and has some explaining to do, right? And sort of say, why are these numbers out of whack with what we thought they were going to be? If they're better than you thought, everything's fine, right? If they're worse than what you thought, then you have to explain why. And if it's just because, things were leaky and didn't work right, that's not a good answer. But if it was, well, there was this unforeseen event and we had to go pay for it, okay, fine. We didn't know about that, but that's a really good, strong management practice, right? And it comes from looking at the accounting, having good budgets, and then sticking to those budgets. And then you don't go and change the budget because things changed. You keep riding through that, and you can change it at the end of the next year when it gets approved. But this is the budget, and those are the target numbers that everybody's supposed to hit.
Then you can forecast where your big losses are going to be.
Yeah, you try to do that. If you think something's coming up, you say, you know what, I think it's going to be, and that's what happens even with these public companies. They will give what they call guidance for the next quarter, and they might see, China's having a very difficult time, the economy's starting to slow, so we're probably not going to sell as much over there, so our revenues are not going to increase as much as they did last year, so get ready for that. But our net income is, because we're planning on this, our net income is going to be strong. So they give guidance, and if the analysts in the market don't like what that guidance is, the stock can take a hit. If the guidance is really bullish and strong, then maybe the stock for the temporary might go up a little bit, but then if they don't follow through on what that guidance was, then they'll get punished, in the market. Right, so you start to think about, anticipate what's happening, they're thinking the Fed's going to raise interest rates, that's going to slow things down or whatever, so our guidance is soft, and now they're a little bit more strong on that's not going to happen. Or, come Friday, there's going to be another government shutdown, that's going to really hamper our business, so, What do you think? Is that going to happen?
I hope not.
Do you?
If you work for Park Service,
Yeah, I really hope
so
not.
she'll be furloughed, I'll be furloughed.
What, were you furloughed last time?
Not last time, because I was in between, but it's affected for my future job, so I'm in the process of trying to get hired. I just left Glacier Park, and so yeah, everything's just kind of, and it's all gonna be like, 70% or 70-90% of their staff is seasonal, and if they can't hire anybody within this time and go through those background checks that take months.
Then you don't have people when you need them at the.
Right, and more battle, things.
See, this is bad managerial practice, what we're doing in our government. That government shutdown that we just had was incredibly painful for a lot of people, and not just people in the government, but then food stamps and everything, it impacts so many people. And now if we're going to do it again, and then people like you or others, you start thinking, gee, I always thought that the government job was like a real, steady and safe job from a credit analysis kind of thing. Now, not so much. And so, am I going to want to be bearing this brunt of this uncertainty every time? Maybe I'll go work for somebody else. And so there's going to be this brain drain and talent drain from government jobs because of all this uncertainty and disruption that we've allowed by having a dysfunctional government allowed to creep into these positions.
Well, even if you don't leave as a government employee, because I'm probably not going to leave my job, but what I did was I took a really hard look at my budget and was like, okay, don't need cable, don't need this, don't need that.
But that impacts the economy as everybody's doing that. Then there's all that other spending is going down because consumer confidence is eroded. Right. And people that are looking at the jobs too maybe you're not going to quit because no, that's a good job and I'll figure out how to do it that way. But somebody's like thinking, should I take this job or this job? Everything's equal except this one's more uncertain because it's government. Maybe I'll go this way. So for years to come, it's going to impact, and it's so and I'm sure every, fiscally responsible government employee that's going to be impacted is thinking like that, and so that's less spending, and when the spending tightens, that ripples through the economy, and so that slows down the economy. So in so many ways, it's incredibly disruptive.
I feel like government employees get this rap about, they're paid well, they get all these days off, yada yada. The majority of government employees make $35,000 to $50,000 a year. They're not these exorbitant CEO wages. And I've worked for the government for 15 years, and I was talking to my mom, and she's all like, well, I'm just really glad that they're not going to pay Congress or whatever. And I'm like, you have no idea. Like, it's not Congress who isn't getting paid, Mom, it's me.
Right. Right, exactly.
And so there's these, these conversations that go around in the public that the government doesn't add a service in a lot of ways, but you could just look at the airline, what happened with the airlines.
As soon as those traffic controllers didn't show up.
Government
Yeah.
regulated system, and as soon as all those guys are done for, because they have time safety regulations,
Yeah.
how long they can be in.
Shut down all the airports. Yeah.
Shut them all down.
Yeah.
Then see what
No,
happens.
it's really, and you're right. They have it's this whole like oh yeah, bureaucracy, bureaucratic, and now we're starting to
Yeah,
realize how important it all is, though, and
It's just intertwined, and like going back
It's
to
amazing.
the comments you were making about history and the SEC and FDR and like all this stuff. Well, before that, there was no federal regulation on any of that
Right.
stuff.
exactly.
And so it was just allowed to be
Right.
crazy. And then it wasn't until the 90s that the government instituted some of their own CFO
To try to have
laws.
regulate, oversight,
Yeah, to
fiscal
make sure
oversight
that
of government.
The government was
Yeah.
doing the right thing. So it's
Well, and
very
even-
hand in hand.
Oh yeah, even to this day, the Department of Defense cannot produce
They can't pass an audit.
a budget. They can't produce a budget. They don't know what they're spending their money on. It's just unbelievable. And we just go ahead and say, well, okay, well, I don't know how, 250 billion or whatever it is, the budget for them, and they can't say, this is what we spent it on.
So
If
I
they were a
think the
company,
Forest Service-
I would fire those guys.
Yeah. And the Forest Service centralized to Albuquerque back in 2005. They took all their finance stuff, and I lived in Oregon working for the Forest Service and had to move here.
Ah.
We could not pass a financial audit. And part of it was because we were so decentralized in all of our accounting aspects, and everybody did something just slightly different.
Right.
And so they had to centralize us, and it just cleaned everything up, and we've had a clean audit for the last 10 years.
Well, excellent,
So-
and that's good business practice. That's
Yeah.
solid, operating. What do you call it, business practice? But operational practice that you know where you're spending the money, so that you can make decisions.
Yeah.
It's just like when we don't make our own budget, and then wonder where all our money went, and so it's the same thing, and that's really, I didn't realize that's not, and they consolidate it up. Yeah, with companies it's been like that too, where they might have all these different divisions, and how do they, make it all work? Another problem, we talk about GAAP and financial statements and U.S. Accounting practices and all. The rest of the world has a completely different standard of accounting. So if you're a global company, which most companies are now, you have to have two completely different sets of books and accounting methods. And there's been all this talk about trying to harmonize, U.S. accounting principles with the rest of the world. Seems like it would make sense, right? But hasn't happened yet, and it looks like every once in a while there's some rumblings about it, but then nothing happens. Yeah.
Do they do it based on isn't there, because accounting really started in Rome and in Italy, right? Like it was kind of, that was the basis.
Well, actually, it
And
started
it's
in
this
Florence.
double
Yeah.
entry accounting. So what's the difference
Yeah.
between what we do and what the rest of the world does?
Well, there's a bunch of differences, and we can talk about it in more detail. The major one that always gets me is I don't want to get ahead of ourselves, but balance sheets, right? That's the next thing. Balance sheets, you have to have the assets have to equal the liabilities and equity. And liabilities and equity are how you fund the assets, right? You either have loans or you have ownership money, and that buys the stuff. And then this has to equal that, right? Fair enough. That's how and so then you have all these line items of the different assets. And in GAAP, what we start with is the most liquid. We go from most liquid to least liquid. So we start with cash. That's the most liquid, right? Because you can use that to buy stuff. And then little by little, there's things that are less liquid, like your inventory. Well, it's kind of like cash, but you'd have to sell all that stuff, and you'd probably have to sell it at a discount to sell it all to raise the cash, so it's not as liquid. And then your machinery and your trucks or whatever, your factories, that stuff is more and more chunky. And then you have, those are all tangible assets, right, the real stuff. And then you have your intangible assets like trademarks and patents, and they're worth something, but it would be tough to raise the money tomorrow to go pay your salaries or whatever, right? So we look at it that way. They do it the opposite. They start with the least liquid and go to the most liquid. So it's just, like in Bizarro World and Superman, complete inversion, So that's just one thing. There's a whole bunch of other, arcane rules in it and all, but yeah, it's just different. And I think our way makes so much more sense on this, and they should do it. But I wonder, well, do I just think that because I've been swimming in this water my whole life, or does it really kind of make more sense to me? Kind of makes more sense to me, I think. But those are the kind of issues that, to harmonize them. So in the meantime, you have to have two sets of books. And companies like BMW or Siemens or something like that, or Sony, they have to, if they want to be listed on the New York Stock Exchange, they have to have American-style books. Did you raise your hand?
No, I guess my face is just showing that my mind is just blown here. I think this tidbit of info just paid for the class itself. It's like, I thought generally accepted was worldwide. I had no idea there was a...
The G was globally accepted. No.
Yeah.
Generally accepted within the lower 48 states and Alaska and Hawaii.
Interesting.
Yeah, and that's another thing. I mean, when we start thinking about this, and audited financial statements, right? And okay, they're audited, they're blessed by the Pope of accounting, and all that kind of stuff. There's a lot of dicey things there too, because these generally accepted accounting principles they're generally accepted. It's even the name of it. It's not like hard and fast laws. And so there's squishy room in there for interpretation, which there has to be, because at the end of the day, what you're supposed to do is make transparent, financial statements that an investor will not be fooled and has all the information on any meaningful numbers, right? But that's hard. It's interpretive. And the financial statements, while they're audited by a third-party firm, who pays that firm?
The company does.
The company. Is that a conflict of interest? You bet, because
Especially
they can
for-
say, hey, Ernst & Young, either you play with us or I'm going to take our $3 million worth of business to this other big, to Price Waterhouse. And so it's like, oh my gosh, I got 2 kids in college. I have I can't afford, okay, well, I'll sign off on these. And that's what happened with Enron. Basically, it had Arthur Andersen. Arthur Andersen was the top premier accounting firm in all of the United States, in the world. But they bent their rules because, that they said that if you don't, we'll take our business elsewhere. And the accounting firms over time, because they had such intimate relationships with their clients, they started to do a lot of consulting work. And so they made these huge consulting businesses and practices that were even bigger than the accounting practices in the firms. And so it was like the tail wagging the dog kind of thing after a while. And those consulting practices would put pressure on the accountants to bend the rules because they didn't want to jeopardize the consulting fees. So after Enron and WorldCom and these other companies cratered, and they made what's called Sarbanes-Oxley, is a set of rules, Sarbanes-Oxley, to a senator and a congressman that made new rules to try to rein in the accounting practices, and they were passed like in 2008 or 10. Part of that was to try to address these kind of things because, and one of the things they did was insist that all of the big accounting firms divest of their consulting practices because that was a conflict of interest. You can't have a consulting practice. So that's why you have Accenture is one of them that used to be, I think, Ernst & Young, or maybe it was Arthur Andersen. Now they have a new name, and a lot of these ones had to divest. Now I think they're starting to creep back together again and make their consulting practice. But that's one conflict of interest. The other is that they get paid by that company. So you can shop for accountants. You can say, you guys aren't going to buy off on the way we did this because you think we're not accounting for our revenues correctly. Thanks very much. You're fired. I'm going to go to these guys because they said they would. They want the business, and we'll give it to them. So there's a big conflict of interest inherent in this whole thing. Where they're trying to make it transparent and third-party arm's length. Really, the only way you could, one way maybe you could do that is if you actually had government accountants that reviewed all the companies and didn't have a dog in that fight. What?
Government accountants don't know how to do
well,
this kind of accounting.
Well, that's one of the challenges, and we'd have to have this bloated infrastructure. We'd take it out of the private sector, and we don't want to do that and all. But at the same time, we have to realize that there are, high-level conflicts.
And
in
if
there.
somebody's gonna do the wrong thing, they're gonna do the wrong thing. So
Well,
you-
that's one
it goes
argument,
back
right?
to
Exactly.
your ethics of-
Just like that CFO, guy for, if he really did a great job of that, and to the point where I don't know if the CEO really realized or not, and he probably wanted to believe it, because, and they all had cognitive biases to want to believe it because that was their success and they looked like stars. So yeah, if people want to get around it, they're going to get around it. But at the same point, we want to make it as hard as possible to do that, and so we keep trying to legislate and trying to rein in, and that's one of the other big tensions is between free market capitalism just going on its way and doing whatever it wants to do because the market knows best, and supply and demand, and the market will determine prices and clear, whatever, and everything's that's what we should do, right? We shouldn't, try to central plan, because when we plan or pick favorites, we're probably going to make a mistake, so don't do that. That's one argument. But then we have this free reign that just, exploits all kinds of people and situations, and, pollutes, and, does all this other kind of stuff. So you have to have some regulatory guardrails or something so that people don't just run off and, things like child labor laws or whatever, kind of things that just, or the FDA to make sure that medicines are relatively safe, or all these kind, or the SEC to make sure that nobody's just gaming, a bunch of widows and orphans out of their money, The government has a role in regulating, and that's always a big tension, is how much, If you have too much regulation, you're constricting business. If you have no regulation, business is running roughshod, and a lot of people suffer because they're being exploited or unsafe conditions and stuff like that. So that's a big challenge in it. So yeah, so generally accepted accounting principles, there's what we go on. And that the industry, up until Sarbanes-Oxley and the accounting industry completely was self-regulating, regulated itself. There was no oversight in the government to say, here's the rules for accountants of how you're going to have it. Don't worry, we'll meet and we'll figure out and we'll self-regulate, and that was good enough until it wasn't. Until it wasn't.
Government didn't even have laws for their own accounting
Right.
until the 90s. Until really the internet came around. With the internet has changed the way everything is done.
It's really remarkable, how recent a lot of because a lot of this stuff seems obvious, and you think it would be that way forever. And by the way, you're right. That's very interesting. The accounting is an innovation that has been absolutely world-changing. I mean, it really made the modern world, arguably. It started in the 1400s in Florence. And that's when you had the Medicis primarily were the big banking family, and because they understood the secret sauce of double entry bookkeeping, right, where you have a credit and a debit, and these things have to balance out, that allowed them to become, that technology allowed them to be the powerhouse of Europe, and allow for all these bills of trade and all that kind of stuff to make commerce work. They made a ton of money on that, and rightfully so. It was a brilliant innovation. It's like the Google of its day or something, right? And to this day, we still do that same type of accounting. And arguably, then what happened was, okay, so 1400s, they made all this money in Florence. In 1452, the Ottoman Empire finally ran through Constantinople, which was the last vestige of the Roman Empire. That's where all the philosophers and the great books were. A lot of those people escaped with these manuscripts. A lot of them ended up at the court of Cosimo de' Medici, and he made a Platonic Academy, brought all these people in, created a library. It was the first time that in Western Europe, since the fall of Rome in 400, that they'd see all these books and suddenly realize this sort of humanism, right? That through philosophy and through that humans were actually capable of a lot of stuff. At that time, it was all religion. It was just God, and humans were down here. And it basically started the Renaissance. And the Renaissance was the engine of the Enlightenment, and the Enlightenment is the engine of us. So you could arguably say that accounting is an inflection point that created the modern world, and it's a legitimate thread that you can take through history. So generally accepted accounting principles.
It really does help you figure out where people's, like if you can understand the business of something or where the money flows or how the money flows, you can understand where people make their decisions.
Oh, absolutely. This is how any company, any enterprise, this is how you do it. And any type of investigation, it's all about follow the money. That's what you do. But certainly for a company, you do this kind of stuff, and then you know some corporate finance, and there's financial decision-making tools that determine the direction of a company. What projects to do, what income-producing assets to purchase, at what price. All those kind of things flow from these numbers, and then applying the time value of money and discounting cash flows of the finance that I'll teach in a few weeks. That's how you determine how to do. So yeah, this is the basis of all smart business decision making. Yeah.
Or corrupt.
Or what?
Or corrupt.
Or corrupt decision making. Yeah, no, exactly. Oh, you bet. Yeah. Because corrupt people, they don't. It's just like the money's not going. They have two sets of books or whatever, and they know exactly where every dollar goes. And a lot of it goes into their, into their Swiss bank accounts or to the Cayman Islands or wherever they're gonna. Or to Cyprus, all these different places where they hide the money. But that's what I think it was. Deep throat in the the Watergate. You follow the money, and that's what it was. Follow the trail of money. It's exactly what we're doing now, right? It's all of these investigations are all about ultimately follow the money, and the whole thing about the most critical player, I think, in this whole investigation of the Trump Corporation is the CFO that worked for our president's father and worked this whole time, knows every single transaction that's going on, and they're working through all those kind of things. But if there's anything, that's how they're going to find it, because all that stuff is incredibly documented,
Or should have been.
It has to be. He couldn't get money from Deutsche Bank unless he had, show them financial statements. Or should have been. You're right. It could be really bad, but I doubt it. I bet it's very, very good. Because that guy, I think, is a very, capable CFO. They all are very smart people. But it all comes down to, too, like you said, ethics, And, in any MBA program or something, they teach ethics, and I've written a lot about this, but it's not really, what business is predicated upon. It's not the number one thing. Basically, any articles of incorporation of bylaws, the charter of a corporation does not have any other, interests in mind other than the shareholders, maximizing shareholder value. Doesn't matter if that might mean that maybe we're, not taking care of our, effluent into a river or pollution into or what we're doing. Think of companies like what's the one that did the OxyContin or the opioids, and now they're in all kind. I can't think of the name of the company. They release board minutes that say we got to get sell more, get those drugs out there, and it's basically created incredible blight on our whole society. So ethics are and all this kind of we're trying to combat people's greedy nature. And that's what happened in 2008 when everything fell apart. Talk about that too.
So I have like kind of philosophical thoughts about this too, because I think nowadays a lot of people, especially with the rise of social media and like kind of that, and this might just be me and my views on the world, but that you are seeing companies come back, especially grassroots companies. They're coming back and they're being like, I want to make sure I'm doing a product that's good for the environment, it's good for people, and it's not all about how much money is my bottom line.
Absolutely, and there's even corporations called B corporations where they include stakeholders outside of just the company, but the community they're in. When we think about these kind of things, think about tobacco companies or sugar companies and soda companies or petroleum companies and carbon loading the atmosphere. And we're all in this denial role of global warming or climate change isn't happening, and we can't really attribute it to human activity, and just to kind of try to keep making the dough. Right, but there are companies that are coming back, and it's lots of branding around green kind of things, whether or not they're actually doing more in that way. and a lot of them are, and in all different ways, like non-GMO, in our food supply kind of things, but and how like Tesla trying to create electric cars so we don't keep having combustion engine carbonization and stuff. So there's lots of companies that are coming around and saying they want to contribute in those ways to. And a lot of people that come around that way too. I mean, think of Bill Gates. Like back in the '90s when they went after Microsoft for monopoly. He really came across as like a not a sinister character, but like a guy who really didn't care, and he was just like driving hard, and now he's become this like statesman with the Gates Foundation of curing malaria and doing all this kind of stuff, and and applying business principles to effectively try to pursue a lot of social socially good programs. So yeah, hopefully over time we'll hopefully pretty soon we'll figure all that stuff out, and that it's good for business. Actually, Al Gore, who was almost going to be our president, and then he made that inconvenient truth thing, about, and he was one of the first saying, "Hey, climate change is happening." Everybody said, "Oh, this guy's out in left field." But for the last few years, I think the guy's name is Donald Blood. He's a investment banker, really sharp guy, and the two of them have made this investment firm, and it's all into sustainable, good stuff, and it's actually outperformed all the other hedge funds and all for the last few years. So.
Are they publicly traded?
No, they're not. They're not. They were going to call it. It's interesting. The guy Donald Blood, and they were going to call it Blood and Gore, but then they've done. But it's called. I have it up on my computer. I forget the name. But yeah, and it's all those kind of things, and they're like projecting like, okay, Exxon, all these. You're valuing your assets as all of those reserves you have in the ground for oil, but you're probably overvaluing those things because in 10 years they're not going to allow you to extract them, and they're not going to be that valuable anymore. So we're going to, short this stock, or get rid of this stock and get another one that's actually good. And they've made some decisions that at first seemed like they were pie in the sky, hippie kind of, and it turns out, nope, their portfolio is outperforming because these are inevitable changes that, maybe the powers that be, the people that have want to conserve the markets they have, aren't thinking that way. But really, when you think about it, this is the way the world is going to go, hopefully. Anybody else have any? The what?
I didn't mean to go off on a tangent with for me.
No, you didn't.
The social.
No, please go off on tangents. I encourage you to go off on tangents because that's where we'll have our dialogues. And anything of this that if I skip over something that doesn't make sense, or you think about it over the next couple of days, come back with questions and stuff. So what I think just in broad terms, I tried to stick to like the income statement today, and budgets, and so next time we'll do the balance sheet, and then the third time we'll do cash flow statements, and then the last time we'll do interconnection and flow and how they all work. So, if we get halfway through and we're done with balance sheets, I'll start on the cash flow. But that's kind of the way I'll move forward through these things. And when we talk about balance sheets, then we'll talk about cash versus accrual accounting, which is key to all of this, and we'll get that concept locked down. But really, for today, revenues minus expenses equals net income.